All right, good afternoon, everyone. Thank you for joining us this afternoon for number 4 out of 6 on the ALEI August webinar series. Oh no, we have someone already with a tech issue, can't hear. Can anybody else hear me right now? We're good?
Yeah, Megan, you're fine.
Okay, thanks, Carol. For the person who can't hear, maybe check your speakers or check if your computer itself is muted. I do that sometimes and I can't hear what's going on. Anyway, welcome to number 4 of 6 of the ALEI August webinar series covering legal considerations for choosing your farm business structure. Today's topic is tax implications and accounting considerations when you choose your business structure. And our speaker today is Mr. Chunwuke Anuaku. I'm sorry, I messed that up. And he is a CPA and business consultant with the W2 Group based in Maryland. So in just a minute, he'll give you a little bit more background about himself and go through the presentation. I just want to remind everyone that questions, please feel free to put all your questions as they pop up into the chat box. And we're going to get to those questions after the presentation. We'll have plenty of time at the end, just like normal, to go through whatever's in the chat box. And then if you have questions, you can unmute yourself and also ask at that point as well. We are recording today, and I will make a copy or upload the recording of the webinar by the end of this week. And you'll also get a copy of the slide deck that is available by the end of the week as well. So without further ado, I'm going to go ahead and let Mr. Anuaku start his presentation and take it away.
Okay. Hey, everybody. Hope you guys are doing well. Hope you guys can hear. Hopefully the person that is having sound issues, we can get that rectified. As Megan said, my name is Chukwunwike Onawaku. I am a senior consultant at the W2 Group, which is a financial services firm. We're located in Upper Marlboro, Maryland. So, the W2 Group, we're a solution-driven accounting and advisory firm. We specialize in bringing a lot of cloud-based solutions and efficiencies to the beginning farming community and mature agricultural operations, doing business with federal, state, and local governments. I want to thank the University of Maryland, ALEI, and Megan Todd for having me speak. Today, we're going to talk about the tax impact on business structure and the importance of accounting. So I know previously you guys have gone over different business structures and how to form them. But today I want to speak about what the tax impact will be based on certain structures that you might choose. So let's get started. Okay, hold on, sorry. My computer, it almost died. Give me a second, let me plug it in. We're good. Okay. So the first thing I want to discuss is business structure and business legal structure and tax elections. So business legal structure is basically a government classification that regulates the specific aspects of your business. Tax election is how your business is going to be taxed. Now, every tax election is a business legal structure. However, every business legal structure is not a tax election. For example, is there anybody listening now that has an LLC? If you have an LLC, please type LLC in the chat. Okay, I see some LLCs. Okay, so those people who have LLCs, based on your taxes, do you fill out a Schedule C? If you use a Schedule C, type Schedule C. If you use a form 1120S, type in 1120S. If you use a form 1120, type that in. If you don't know, it's understandable. Form F, okay, Schedule C, okay. Okay. So the reason why I brought that up and it's important is because as you see, there are more business legal structures than there are tax elections. So if you choose a business legal structure that is not a tax election, then you're going to have to choose how you want your business to be taxed. So I asked about LLC because as you can see, LLC is a business legal structure. However, it is not a tax election. So if your business has a business legal structure as an LLC, you have to choose how you want to be taxed. So if you're a Schedule C, Schedule F, you are getting taxed as a sole proprietorship. If you are using an 1120S, you are getting taxed as an S Corp. That's the S Corp election that Jen has. So if you have a business legal structure that is not a tax election, you will have to choose for your business how you want to get taxed. On a federal level, your business legal structure determines how you will get taxed. On a state level, it has liability ramifications about if someone sue you, how things would work. So your tax and your liability implications will differ depending on the business structure that you choose. So again, business legal structure, tax election, two different things. Again, tax elections are all business structures. However, every business legal structure, not a tax election. So I just wanted to drive that home. So the business structures we'll be covering today: sole proprietorship, general partnership, limited partnership, S corporation, C corporation, limited liability companies. We will be covering each of these in a little more detail in the next couple slides. Okay, so first is a sole proprietorship. So a sole proprietorship is what we call a pass-through entity. What does pass-through entity mean? That means that if you have a business and it's a sole proprietorship, whatever profit or loss is made, that profit or loss passes through the entity and goes to the stakeholder and the individual owner. So if you have a $10,000 loss, your business, if you have 10,000 in income, the actual sole proprietorship does not pay the taxes. That 10,000 will flow through onto a Schedule C or a Schedule F on your Form 1040. That's your individual tax return, and that's where you will pay the taxes. Now, a sole proprietorship, you can take business losses against other active income. For example, let's say that you have your farm and you have a spouse, and your spouse is a W-2 income worker. So let's say for 2021, after taxes, they made $50,000 in income. However, the farm you had, this is the first couple of years, so there's a lot of startup losses. The farm you had a $10,000 loss. You guys as a couple together, you guys will not be paying tax on the $50,000 that was made. You'll actually be paying tax on $40,000. It's the $50,000 W-2 income minus the $10,000 loss. Again, that's advantageous, especially in your first years of operation, because there's likely to be a lot of startup net losses as well. Now, even though the business does not pay tax and the income or loss flows through to the individual, they have what we call self-employment tax, which is 15.3%. Self-employment tax is basically a combination of all the payroll taxes that you would have paid had you had been a W-2 worker. One of the downsides to a sole proprietorship is that there's unlimited personal liability. So in the situation that your farm owes people, they can come after your personal assets in order to pay off these different liabilities. And a sole proprietorship dissolves upon death. It does not continue after the owner passes. So in the early stages, a sole proprietorship can be good, not too much, really no limited paperwork to fill out. Any losses I can deduct against any other active income, and that will lower my taxable amount. However, there is unlimited personal liability. So a sole proprietorship will be a good structure as you start, but as you grow in revenue, you will start to want to consider other structures that can give you, create a barrier separation between the business and the personal. So the next business structure we will talk about is a general partnership. A general partnership, similar to a sole proprietorship, again, is a pass-through entity. Now, the tax form is what we call a K-1. A K-1 is basically a partnership tax return. So if, let's give a scenario where we have a farm business, right? There's two partners. One owns 60%, one owns 40%. Year 2021, the farm had a net profit of 10,000. That means that on the K1 for the partner that owns 60%, it will show a net income of 6,000. And then on the K1 for the 40% partner, it will show a net income of 4,000. That K1 flows onto your personal tax return. And again, as you that is where you will pay your taxes, because the actual partnership does not pay taxes. It is a flow through entity. Again, you can take business loans, you can take business losses against your active W-2 income, which is advantageous, as we said in the previous slide. Self-employment tax, 15.3%, unlimited personal liability, and it dissolves upon the death of one of the partners. A limited partnership. So a limited partnership has a lot of the similarities with a general partnership, but there are some differences. So first off, a limited partnership is what they call organized within a state. That means that it's not recognized on the federal level. And if you can flash back to the business legal structure versus tax election slide, limited partnership was not a tax election. Why? Because as I stated, your business legal structure on a federal level is your tax implications, is how you get taxed. So because limited partnership is only organized within a state and not recognized on the federal level, you can't get taxed as a limited partnership. You'll be taxed as a general partnership. Now, why would I want to do a limited partnership? It allows for investors, because there are some people who may see your farm and say, hey, I actually don't want to be in it on a day-to-day, but I want to help you invest, help give you some startup cash, help give you an infusion in cash so you can buy more materials and whatever you need in order to help grow and scale the farm. So they'll basically be a silent partner. They won't have any decision-making rights. They won't be involved on a day-to-day. They'll just have a certain percentage of the firm, and you guys will basically create an agreement of how people will get, how income will be spread out and things of that nature. But that's the advantageous portion. The advantageous portion of a limited partnership is I can have an investor come in and help me out with my business. And another difference is that a limited partnership does not dissolve upon the death of any partner. It continues in perpetuity. An S corporation. So an S corporation is a pass-through entity as well. That income, that loss is going to flow through that S corp and go onto a K1 as well. So both in a partnership and an S corp, you get a K1. However, the tax forms are different. In a partnership, it was a form 1065. For an S corp, it's a form 1120S. Now, an S corp is something that can be very appealing to some people, because as you see, distributions are not subject to self-employment tax. So that means that you're not paying that self-employment tax on anything you distribute yourself. However, we cannot go crazy with our distributions. The government is not just going to let you pay yourself a $10,000 salary and then do 90,000 in distributions. You must have a reasonable salary, and distributions cannot exceed your stock basis. S corp is going to have perpetual existence, and an S corp is actually the first business legal structure that we're discussing that gives you limited personal liability. So that means that your personal assets are generally protected from any business liability. However, all the previous business legal structures, if there was any liability related to the company, then you as an owner operator, you were liable, unless in a situation you were a limited partner. And that limited partner, their liability is capped at their initial investment. Yes, so Stephen, only the limited partner, what happens is the liability is capped. So if a limited partner invested 50,000 into your farm, the most they can be liable personally is 50,000. So in a situation where the farm, let's say the farm got really deep into the trenches and now is $300,000 in debt, that limited partner is capped at the 50,000. The rest of that 250 is the responsibility of the general partner. So only the limited partner has some personal protection, but the general partners do not. So yeah, that was an S corp. Okay, so I'll touch on that question a little bit later. Stock basis, it's a little bit hard to explain. It's a little bit convoluted. So I don't know if I want to get into it because it might just make things a little bit more muddy. I'll think about it as we move through the presentation if I want to kind of like touch into it. A C corp, C corporation, tax form 1120. Now, one of the downsides to a C corp is what we call double taxation. So double taxation occurs when a business runs throughout the year. It'll have a net income at the end of the year. That corporation must pay tax on that net income. Then after it pays its taxes, it can now distribute dividends to its shareholder. Once you as a shareholder receive that dividend income, you are now also going to pay tax on that. So the company, the C corp was taxed once, the individual was taxed. That's why they call it double taxation. So some people don't like corps because of that. Also, I know you guys probably discussed it, but the paperwork for a C corporation can get a little complicated and there's a lot to it. But the tax rate is usually around like 21%, which is advantageous because the personal tax rate can get up to 40%. So that's a big difference. C corp as well goes into perpetual existence. The reason why a business dissolving after the death of a shareholder versus it continuing in perpetual existence is important. It's really about succession planning. So, farms a lot tend to be family businesses. So picking a structure where it might dissolve at the end, at the death of a shareholder, that might not be what you guys want to do because it may want to be passed down to the children, or it may want to be passed down to the nieces or passed to somebody else in the family, and having to close a business just to restart and reopen it might not be what you want. So as I stated earlier, in the early part of your farm, you might do one of those business legal tax structures that may dissolve upon ownership, but as the farm grows, as it begins to scale, you might want to look into switching to a business legal structure that, one, is going to have perpetual existence, and two, going to give you some limited personal liability. Lastly, the mother of them all, the limited liability company, the one that everybody loves. Something about limited liability company, I feel like it's just sexy to people. Like everybody wants to have one. So LLC can be a single member LLC or a multi-member LLC. Now, if you're a single member LLC, you tend to get treated as a sole proprietorship as far as tax purposes. But if you are a multi-member LLC, you can be treated as an S corp or C corp. Again, LLC is only organized within a state. That means that it is not recognized on a federal level, which is why you need to have a tax election if you chose an LLC. That's part of the reason why I had people, who had LLCs talk about what tax form you chose in the chat. You could be a Schedule C, you could be an S corp election, that's 1120S, or you could be a C corp election, that's an 1120. So an LLC does dissolve upon death, but as far as personal liability, it is limited to, so that is good. So that gives you a barrier of protection from your personal assets to what's going on in the business. So that is always advantageous. Okay, so I want to shift a little bit and talk about accounting. So accounting is very important. Now, this is coming from a CPA, so you can say I'm a little bit biased, but I think accounting is very important. Why? To me, accounting is the language of business. Now, financial statements tell a story of what occurred in a business. So if you can read financial statements, you can basically understand what's going on in a business, what happened in the business for whatever period. If I'm looking at your farm's financial statements for 2021, I could pretty much read and tell a lot of stuff that's what's going on. So why is this important? Now, if I were in a foreign country, let's say I was in Haiti, right? In Haiti, there's a lot of sections that speak Haitian Creole. I don't speak Haitian Creole. So if I went to Haiti and I needed to maneuver around, who would I look for in order to be able to make things smoother? I will look for a translator, someone who I can speak English to, they can understand. They'll translate it to Haitian or Creole, and they'll speak to whoever the native person is, or just show me around and things like that. When it comes to business, your CPA, your accountant, your financial advisor, we are your translators. We're going to take your financial statements, we're going to make sense of them, and we're going to spout it out to you in English so you can do different things based on the data that is given. But if you can't read your financial statements, you really don't know what's going on in your business. So you might be going and doing the day-to-day, but it's going to be hard to make decisions. It's going to be hard to do different things because you don't know exactly what the results are in your business. So accounting is definitely is very important. We're going to bring the business expertise and you're going to bring the farming expertise. So once I translate your financial statements and speak them back to you, you can take that information and use your farming expertise in order to run and grow your business. Now, what types of things can you do with the info given by an accountant and accounting in general? So accounting has several roles. Accounting has several roles. It could be keeping the company on track, keeping the company organized. So tracking, we're talking about tracking income, we're talking about tracking expenses. You need to be organized. You need to know how much expenses, how much money you spend, how much money is coming in. If you don't know that, it's going to be very difficult to run a business. Why? Because accounting provides info for decision making. So if I wanted to, okay, let's say that I'm currently located in Upper Marlboro, Maryland. If I wanted to drive to New York, my GPS is going to give me a path, but the first thing the GPS is going to do is it's going to locate exactly where I'm at, because it's hard to go to a destination if you currently don't know where you're at. So by tracking your income, tracking your expenses, you know exactly where you're at. That way, when you're trying to make decisions, you can map a plan to your destination. But it's going to be hard to map your plan to a destination if you don't know where you're currently at. So if you have the goal of saying, I want to make $100,000 in revenue next year, my first question is going to be, well, what is your revenue now? Because that's going to determine things. So like if you have crops and you sold X amount of crops and it got you $10,000 in revenue, I'm going to be looking at saying, okay, we have to 10x this in order to get to 100,000. But I can't give you the path to 100,000 if I don't know where you're currently at, even if you're at zero. We need to know where we're at in order to make a path to where we're going. Kathy had a question. Sorry, it would be Schedule F, not Schedule C. If you're a farm, you'll be Schedule F. The role of accountant is the role of accounting. So you're needed for a loan or an investment. So if you're going to the bank to get a loan, you're going to need financial statements. If somebody wants to invest in your business, the first thing they're going to ask about is, let me see your financial statements. I know people they're great salesmen. You as a farmer, you might be a great salesman. You're able to convince somebody who wants to invest and have some money. You can give them the spiel about, how you started your farm, why you started it, how accounting operations is going. But at the end of the day, they're eventually going to say, hey, I need to see your balance sheet. I need to see your profit and loss statement, because again, accounting is a language of business and they want to be able to read your statements and match what you told them to what is reported on your statement. So accounting is very important. It also helps you evaluate business performance. So for example, let's say we had a farm who wanted to increase their crop yield. So they decided, okay, we're going to invest into better soil treatment, invest into some higher quality fertilizer, right? Now we're bumping up the expenses because this is going to cost more money. So maybe at the end of Q1, we'll look and see, okay, this quarter you spent an extra 10,000 on soil treatment. Let's see if it actually yielded a higher crop yield. The reason we're doing that is because there's no point to continue to invest in the soil treatment if we're not seeing on the back end a higher crop yield. But you might not be able to make that decision if the numbers and the financials can't show you how much more you spent in expenses, what the crop yield is now. You could probably even create a key performance indicator looking at crop yield. So accounting can help you evaluate business performance. Let's say you wanted to make 10,000 in Q2. At the end of Q2, we can look to say, okay, you made 8,000. We didn't quite hit the goal, but we got pretty much there. Now we can start a discussion about what do we do to get to 10,000. Where there's some expenses that maybe were higher than normal, we can kind of look into any unusual activity to start to break down, okay, we didn't hit our mark, but we got close. What do we need to do in order to hit our mark? So evaluating your business performance is very important. Accounting also helps you create a budget and create future projections. So let's say we have a hemp farm, right? And we know that on this hemp farm, there are 400 plants. Based off those 400 plants, the farmer is going to know, okay, how long is it going to take me to grow this hemp plant? I know how much I'm going to charge for this hemp plant. So now based on that information, we can project out your whole year and say, okay, we know based on, you know, the timing of the hemp plants and the sales of the hemp plants, if you sell all these hemp plants, you're going to make $200,000 this year. Now, based off that, you can start to make decisions on your budget saying, okay, well, I thought about bringing in another employee, another worker, they're going to cost me 60,000. So if I'm going to make 40,000 based off what I made last year, I think I can afford it. So you need that accounting to budget, to project, and to make decisions about your business. Lastly, accounting is going to help with your legal compliance. Legal compliance is basically taxes. Your tax on profit, your payroll taxes, etc. One thing the IRS does not play about is their taxes. That's the whole reason why they are there. They will add interest, they will add penalties to whatever you owe. How do you know how much you owe? It's going to be based on your accounting. Your income taxes are based off your income. So if you don't know how much you made, you don't know how much you owe. Payroll taxes are going to be based on how much you pay your employees. If you're not recording your employee expenses and, you know, having your different accounts showing like how much was withheld for Social Security, Medicare, and things of that nature, that's going to go back to the government, you might give to the government, and that's something that you might owe. But if your tax and your accounting system is on point, then you won't miss anything. So legal compliance is very important. Also, they have this term called good standing. Good standing means that with your state, all your liabilities have been paid off. So I'm in the state of Maryland. As I said, I'm in Upper Marlboro, Maryland. Maryland has a business personal property tax return. You have to fill that out every year. Even if you don't have business personal property tax, you will have to pay at least a $300 fee. If you do not pay that $300 fee or whatever else fee is owed on that property tax return, if you go on the state of Maryland's website and you look up your farm, it'll say that it's not in good standing. That can prevent you from things like getting a loan, doing business, and things of that nature. So something simple as not paying taxes can impede your operation of your business. So legal compliance is very important. How do I get to that legal compliance? Accounting, accounting, accounting. So to drive the nail in the coffin, accounting is very important. So there's bookkeeping and there's accounting. Bookkeeping is really for reconciling your books in order to prepare those taxes. Accounting it's a little bit of a step up. We go a little bit more in depth. We're going to talk about your business. We're going to talk about how your general ledger is set up in order to maximize what we're trying to gain. And also maybe we can set up in a way that when you look at it, it becomes a little bit more clear. So accounting is a little bit a little bit of a step up from bookkeeping, but bookkeeping will organize your expenses, organize your income so you can pay your taxes. Now, a couple statistics I looked up: an accounting system will increase your success rate by 10%. 10%. Just having an accounting system simply does that. I know there are a lot of people probably do things by hand. A lot of startups, they might not even record expenses and income. But the sooner you implement an accounting system into your business, the better off you'll be. Lastly, the right CPA or financial advisor will increase your success rate by 20%. 20% is a big number. Like, a lot of businesses fail within the first 5 years. So if there's anything you can do in order to increase your success rate, I would say do it. So getting an accounting system, getting the right CPA or financial advisor will lead your business in a path towards success. So those are very important. All right, so a little bonus. I know based off that last slide, you're probably wondering, okay, a financial advisor or a CPA is going to increase my business's chance of success by 20%. What type of questions am I going to ask my CPA? There's a lot of CPAs, there's a lot of accountants out there. First thing, you want to know what type of banking relationships they have. You're going to be operating with the bank. You're going to have a business bank account. So when your CPA, your financial advisor, your accountant has banking relationships, it makes the process a little bit smoother. They can kind of cut through a lot of the red tape that accountants and CPAs who don't have business banking relationships don't have, they'll run into. Ask the CPA, ask the accountant, what type of clients do you work with? So accounting is a discipline, it's a general knowledge. However, when you start to specify into different industries, there is what we call industry knowledge that an accountant can have that can bring a lot of value to your business. So I would suggest, if you're looking for an accountant or a CPA, if they don't have farming clients, I wouldn't go to them. I would try to find somebody who has farming climate experience, because there are some things that they know, there are some things that they understand that will help them in the process of working with you in order to make your accounting system smooth, to be able to guide your business and help you reach your goals. Ask them what is their background and their specialty and the years of experience as well too. So again, you want somebody who has some farming experience. You also want somebody who just has some general accounting experience. I know for me, the more years you have in it, there's just certain things that you pick up. There's a lot of scenarios that you see, and you can answer questions, and the questions you can't answer, you built a network to reach out to people to answer those questions. So that is important. Ask them, what do you expect from me each year? Now, you and your accountant is a relationship. It's like boyfriend, girlfriend. It's like marriage. Like, you need to know what they expect from you in order to, it's almost like, help me help you. What do I need to do to help and make your process easier? Also, what you might find is when you're comparing accountants, you'll say, hey, accountant A wants me to do a lot, versus accountant B is keeping it very simple. And I think I'm going to get the same results. So I might just choose accountant B because he's asking for less on my end. Or it might be maybe accountant A is asking you to do more because it's going to help you in the long run. But if you don't know that information and then didn't ask it up front, you can't use that as a determining factor. I'm going to get to your question in a second, Leslie. So know what accounting software the CPA or the accountant uses. Are they using QuickBooks? Are they using Xero? That's very important, because each accounting software has different third-party applications that can connect to it. You know, is your payroll system going to connect to it? Is your benefit system going to connect to it? So you need to know what software they're using, because you're most likely going to be in the software, not actually doing transactions, but probably going to be poking around, looking and doing things of that nature. Are you or is your firm licensed in the state to do public? Are you or your firm licensed in the state to practice public accounting? So that gets to Leslie's questions between a CPA and a public accountant. So basically a public accountant is anybody who's gotten a degree in accounting and is practicing. A CPA means that they actually sat for the CPA exam. So I sat for the CPA exam. Well, there's multiple CPA exams. I don't know if we want to get to that story, but you have to pass 4 tests, and then depending on the state, you also have to do an ethics exam. That for me was probably 1.5 to 2 year process to passing all 4 of those tests, and you have to pass it within an 18-month period. If not, sessions expire and things like that. So the difference between a CPA and a regular an accountant is because they have passed this test in order to show, hey, I have the knowledge of this general accounting, so I am more trusted. On top of that, there are more regulations for a CPA, so they're going to be more careful in what they're doing with your books. I know for me and Jeff, who's the principal at the W2 group, we joke a lot of times. We're just like, yeah, I'm not doing that, because any chance of me losing my CPA license, I won't be doing it. I didn't spend 1.5 to 2 years of my life to just throw it away for something very simple, very minimal. So there's going to be, I feel, when somebody has a CPA, there's going to be a little bit more care that is going to be put on it, because you are on the line and the regulations for you are going to be a little bit more strict. Is one preferred over another in personal preference? I'm biased. I'm a CPA, so I prefer CPAs over accountants. I prefer CPAs over bookkeepers, just because a lot of times what people don't notice is there tends to be a disconnect between what the client is asking for and what we're actually delivering. So you think that we're just here, a lot of people think we're just here just recording transactions and things of that nature. Well, a lot of accounting systems are digital now. They're speaking to different applications. So we're not just recording stuff, we're making sure it's recorded in the right way. We're making sure that it's presented well. We're looking through for any anomalies. I'm looking to see, okay, Q1 to Q2, for some reason, this expense went down. What happened? I'm digging to see, because as Jeff always said, a boring business is a great business. Typical expenses each month, things are flowing. When I start to see a lot of variations of expenses, when I see a lot of variations of income, I'm like, okay, what is going on with these fluctuations? I'm starting to dig in to see, are there any errors? Is something new happening, or things of that nature? So I prefer a CPA just because they can bring a lot more expertise, especially a CPA who works in the industry that you're doing. So a CPA who has other farming clients, because now they're going to bring you some industry knowledge that you may not have known. Ask who will be directly handling my account, because a lot of times you may be talking to one person, but there will be another person actually doing the work behind the scenes. So you want to get an understanding of that. What is the fee structure? So how are they charging you? That's something very important that you need to know. Lastly, ask them what services they offer. So maybe they might just be offering you accounting services, but maybe they also have tax services as well. So at the W2 group, we have accounting services, we have taxes, we do consulting as well. And one of the best things I think is when I have one customer who's all in-house. So we're doing their books, we're doing their tax return, we're doing some tax planning, and on top of that, we're doing some financial consulting. I think that is the best place, like a one-stop shop, because if your accountant is not talking to your tax person, there's going to be a disconnect. If your tax person and your accountant are not talking to your consultant, there's going to be a disconnect. But when you have it under one house, like we do at the W2 group, we're all talking about this. Oh, hey, this is going down. Like, okay, I see this happening. The accountant saying, oh, I see this happening in month A, what's going on? Now the tax person is thinking about the tax implications. The consultant is now looking at it and see, okay, how's that impacting the business? So we're all under one roof, diagnosing your business and doing what we do to keep the business health high. So that's why it's important to know what other services are being offered by your accountant. Okay, that is the end of my presentation. I'm going to look in the chat and see what questions I might not have answered. If you have any questions, go ahead and drop them in the chat. Let me try to start from the top. Okay, we talked about limited partnerships and the benefits. Okay, I think I'm gonna skip stock basis because I just think that it's more confusing. General explanation because it's very nuanced. So I'm just going to skip that. If you run into that issue with stock basis, that's something to discuss with either your CPA or your lawyer, things like that. That's what I would suggest. A farm will be a Schedule F. I was saying Schedule C, I know, but it's the income from the farm will flow into the Schedule F and you'll pay taxes on your individual return. Discuss the first week, we would have a reduced fee. All right, the difference between a CPA and a public accountant, we talked about that. At what point in starting a business do you consult with an accountant, hire an accountant? As soon as possible. As soon as possible, I would say, because the right CPA can help you with the business structure that you choose. So even from choosing a business structure, starting a CPA, I think that is very important to get an accountant or a CPA as early in as a process, because there's a lot of business acumen that comes with being a CPA. So we're not just here just to record your books. We're here to give you business knowledge that you can use in your decision making. So I would get a CPA as soon as possible when dealing with your business. I mean, I understand that, it always can't happen that way, but that would be my suggestion. Are there regular recertification classes as tax and financial regulations change? Yes, every year we have to do what we call continuing education. You have to have a certain amount of hours in different industries in order to make sure that your CPA license is renewed. There's also conferences every year because, as you said, regulations are changing constantly. So we have to stay up to date. We have to make sure we're doing our continuing education in order to keep our license active. I've been using my own credit card for purchases and recently opened a business account. Can I incorporate my credit card purchases in business tax or personal tax? I have an LLC. Okay, so if your credit card was used for business purchases, then yeah, they can go into the business. It will just depend a little bit on your accounting system. So we deal a lot with QuickBooks. With QuickBooks, there's a way that I can bring in your personal credit card and I can basically put all the expenses. I'll create a credit card, a specific account, and I'll put all the expenses in there. And then we use a third-party app where we can basically send you it and you can label, okay, this was a business expense, this was a personal expense, this was a business expense. And then we can separate the business from the personals to make sure that all your expenses are going to be recorded in your accounting system. So yes, that is not an issue. I'm glad that you have switched over to a business account though, because that is the best. Because again, you said you have an LLC without partners, so you're a sole proprietorship. Okay, you're a sole proprietorship as far as tax purposes, but your business structure is an LLC. So yes, you always want to make sure please, as soon as possible, do get out of commingling your funds. So as soon as you can, get a business account. As soon as you can. You do not want to continue to be in year 1, year 2, year 3 using personal credit cards and things like that. It just gets very convoluted. Also, it's like, how serious are you about the business if you don't have a business account? So I would highly suggest as soon as possible. I understand, again, with the accountant, not bringing one on early, I can understand that. On the early part, using personal credit cards to get things done, I can understand that. But as soon as you can, get a business account. As soon as you can, reach out to an accountant or a CPA to get some insight. Sorry if I missed this. Is there a good state? I don't think there is a good statewide CPA, but As I've learned in my marketing class in college, word of mouth is the best form of marketing. So if you know somebody else who runs a business and they have an accountant, start to reach out. That accountant might not know much about farming, but most accountants know accountants. So they might be able to point you into the direction of an accountant who has farming experience. So yeah, I would go word of mouth. I mean, you can Google search to see if you can do like, CPAs in your state, in your city that work with farming clients. Like you can even start with a Google search like that, go online, look at reviews if you can, and things of that nature. But word of mouth to me is the best marketing experience. So you can reach out to anybody you know that has a business and ask them about their accountant and start from there. Does it matter whether we specify EIN or SSN on the Schedule F? Is it possible to report grants received by the farm in the Schedule F? Difference between special depreciation and section 7.9. Can CPAs just do Schedule F? Okay, lots of questions. Okay, let me, so does it matter whether you specify EIN or SSN? So an EIN is an employment identification number. SSN obviously is your social security number. If you are incorporated, I would use your EIN. I would stop using your SSN. You only should use your SSN if you're not incorporated in some way or form. So, it tends to be that sole proprietorships, you're going to use your SSN because a lot of times there's not a lot of formal documentation, but I believe with a partnership, any type of corporation or something like that, you're going to apply for EIN. And even with a sole proprietorship, you can even apply for EIN if you want to. So if you have one, I would suggest using the EIN. But if you're just, starting your business in the early stages, your sole proprietorship, you're going to have to use your SSN. But as soon as you get an EIN, use your EIN on your tax documents. Is it possible to report grants received by the farm in the Schedule F? Yes, I do. Yes, it is. So it's just going to be considered as income. And also, if you're saying Schedule F, I'm assuming that your farm is for profit and not non-for-profit. But yes, there should be a space for you to report grants. It will be considered income. Difference between special depreciation and Section 719. So special depreciation, I'm not sure about. Section 719 deduction is basically, so with accounting, sometimes your books that you record in your GL and your tax return, there are going to be some differences because on your tax return, they allow you to be a little bit more aggressive with your depreciation. So depreciation is basically so let's say we have a farm, right? And we buy a tractor for the farm. The tractor was, let's just throw out a number, 15,000, right? Depreciation is taking that expense and spreading it out over a longer period of time. So you tend to do it evenly. So let's say your tractor equipment has a 5-year useful life. Your useful life determines how many years you're going to spread out this charge. That means that every year you're going to deduct 3,000 in your general ledger. But tax laws say, hey, you might be able to deduct the whole thing this first year, or you may be able to deduct half. That's when you start to get into special depreciation. That's where you start to get into Section 719. So basically allows you to take the full expense, or it might allow you to take half of that full expense early, because the more expense you can take early on, that means the less taxes you're going to pay up front. So that is going to get into your special depreciation. That's going to get into your Section 719. Can CPAs do just Schedule F, or would they prefer doing my entire return? I would prefer doing your entire return. I wouldn't just want to do your Schedule F. I think, honestly, I don't think a CPA would just do your Schedule F. Like, we would want to do the whole thing, because again, it's almost like everything's in the house. I don't think you want, personally for me, I think if you're a business owner, I would try to find a CPA who's going to do your personal taxes and your business taxes, especially if you're a Schedule F. I would suggest that. Okay, I think I got through all the questions. If I missed your question, go ahead, drop it in the chat. We still have time, so.
Yeah, we still have 10 minutes. Thank you so much. I think you did a great presentation, and you went for the questions. I didn't want to like interrupt your flow. We got a new one actually.
Do you require a EIN for a new business? So again, EIN, SSN, it kind of just depends on whether you filled out the paperwork to be incorporated. So it's not a requirement, because again, with a sole proprietorship, you do not necessarily need an EIN. You can just use your SSN. But as I said, it might be better early on to have a sole proprietorship, because you can deduct those business losses against active W-2 income. But as you increase in revenue, as you start to get more and more years in business, I would suggest getting an EIN, and also getting to a business structure that allows some separation between personal and business, so that your personal liability, your personal assets are protected. Let's get to Leslie.
Because I had there was a question in the chat, and I think you went by it. And cards. So how do you categorize like the initial investment? So whether I have as a sole proprietor or as an LLC, I put in, $10,000 so that I can buy stuff, whatever. What is that? An investment, a gift, a grant? What is that? And how do you categorize that?
So that is going to, oh, sorry.
So well, I mean, because it's different from personal, and now, because now I've given it to the business. So it's business money now. And so say I'm writing checks because I don't have yet a credit card. How does that get categorized?
Okay, so your initial investment, so you giving money to your business is going to be an initial investment. Is going to be so that's where it will be recorded. So you'll probably debit your cash or whatever bank account it is, and then you'll credit the equity section. So that's what is considered. Once it goes into the business, that's now the business money. You can use it to do whatever you need to do. So it's not going to be considered income because you gave it out your personal pocket, but it's going to be in the equity section under your initial investment. Grants are going to be considered income.
Okay. And it's good to, so if I did it by check, obviously I need to make sure I have the check from me as a person, and then the check entering as the business, right? Those kinds of that kind of paperwork, keeping those kinds of records.
Yeah, and I mean, if you have a bank account, once it hits your bank account, that's kind of the record that, it's good from there, basically. So yeah.
Right. Thank you.
No problem. Let's get to some more questions. Hi, are receiving a copy of this presentation? Yes, you are. Is a general partner's loss limited? No. Unlimited liability. So whatever the business owes, you're going to have to come up with it. And because you are a general partner, they can come for your personal assets. So no, a general partner's loss amount is not limited. Will that be a loan form of business owner?
So that question, it looks like, I think that was a follow-up from your conversation with Leslie about and like $10,000, for instance.
It would be considered an investment, but you can also loan money to your business as well. But that can get a little convoluted as well too, because on the personal side, whatever interest that you get from your business, you're going to have to record as interest income on your personal statement. So now I'm not saying one is better than the other. It's just each has its own. So when you give money to your business, it could be a contribution or it could be a loan. It's just how you structure it. I hope that makes sense. Can it be a 0% loan? No, they would just consider that an investment. A 0% loan is basically an investment. So I wouldn't do that. If you're looking to get some money out of the business, there's options. You could pay yourself, you can do distributions and things of that nature, but I wouldn't make a 0% loan. The reason being is that in accounting, they talk about, they compare things to the market. Any bank you're going to, you're not going to get a 0% loan. So they're not going to let you do a 0% loan to yourself. To the business, K1 loss. This K1 loss, not the liability. Okay. I was referring to the business K1 loss, not the liability. Pat, I'm a little bit confused on your question because I think it's broken up. So I think you were asking about the general partner's loss. Is it being limited? And I was referring to the business K1 loss, not the liability. Okay. I think I get what you're saying. Let me know if this is not the answer you're looking for. So when you're taxed, you're going to be taxed as a general partnership. So whatever percentage that general partner owns is going to be the percentage of a loss. So even if it's a limited partnership, the limited partner owns 30%. I, as a general partner, own 70%. In that year, if we have a loss of 10,000, it's going to be split 70-30. I'm going to show a loss of 7,000. The limited partner is going to show a loss of 3,000. Let me know if that answers your question. If we are a married couple filing jointly, will we set up an LLC as a sole proprietorship? Only if one person is basically running the business. If it's both of you, now you have two owners. Sole proprietorship is only one owner. Once you get more than one owner, you can't be classified as a sole proprietorship. So if whoever you are married to is not really like running the business on a day-to-day, then yes, you yourself can still set up a sole proprietorship. But if both of you are actively running the business, then it won't be considered a sole proprietorship in business structure. Does a K1 count as income to purchase a property? So a K1, if there's net income, is going to count as income on your personal statement. It always will be. It's either going to be income or it's going to be a loss, and it tends to be able to be deducted against your W-2 active income. So it will be considered an income. Does investing in business provide any tax benefits as an LLC, since as a sole proprietorship, it helps with getting some refunds? So does investing in a business provide any tax benefits as an LLC? I mean, outside of the normal tax benefits of just investing, which is, your income go up and things like that, I don't think so. Yeah, I don't think specifically as an LLC. I'm not too sure on this question. Does investing in a business provide any?
So yeah, so my question is, if I'm putting money in my LLC from my personal account, when you do it as a sole proprietor, I did that for a year. I can report that on my tax, and that helps me with sort of maximizing my return, my refund from taxes.
You can record what on your taxes? Your investment into your sole proprietorship?
Yeah, so the costs I had for starting the business when I was sole proprietor.
Okay, but
when you do that,
No, I was about to say, any cost that you incur in a business is going to get deducted on the business's financial statement. So in a sole proprietorship, it rolls into your personal tax return. Your LLC, it depends on the tax election, because you can be an LLC and get taxed as a sole proprietorship, it'll flow through. You can be an LLC, get taxed as a general partnership, it'll still flow through on that K1 of your personal tax return. If you get taxed as a corporation, though, the corporation is always going to be separate from your personal tax return. So I guess that's where you might not see the benefit, is if you're getting taxed as a corporation, those losses are going to stay with the corporation, versus if you choose a tax structure that it flows onto your personal tax return, then you'll see it on a personal benefit as well too. So does that answer your question?
Yeah, yeah. Thank you. This was really
No
helpful.
problem. No
All
problem.
right, I think we're at 1 o'clock, so I think we'll take one last question because Naomi and Tasha have had their hand up for a few minutes, but after that, we're gonna have to close the webinar today. Go ahead, Naomi and Tasha.
Hi, thank you. Slightly convoluted question. So my partner pays, the mortgage is held in his name. We jointly own the farm on our property deed. Can I consider it rent to pay towards the mortgage, even though I'm not legally responsible for it?
Yes.
Okay.
In short, yes, but obviously your farm is not your whole property, so it's like you have to determine the portion of it.
Right.
Like a lot of times you can determine a portion by a percentage, or you can just say, hey, I'm going to start charging the business X amount for rent. But there's it could be capped as well too. But yes, you can charge your farm rent based off your personal house. But again, you're gonna have to report that rental income on your personal side as well too. Like you can't just get that income for free. You have to show it on your personal side. Yeah.
Yep. Familiar with it. I just wanted to make sure I was doing it the right way before we started all of the paperwork. So thank you.
No problem.
Amazing. All right, so we are at 101. I'm gonna go ahead and wrap. I said that's the end. You did an amazing job. And thank you for your time and for answering all those questions at the end. We are going to provide, like I said, the recording of this webinar by the end of the week, a copy of the slides as well, and that will include the contact information for anybody that wants to follow up and ask more information about accounting and things like that. So with that, I will say I hope everyone has a great afternoon and enjoys the rest of your week.
All right, enjoy the rest of your week, you guys. Thank you.
Are you sure?